What's going on, everyone? Leled here. In this video, I'll be going over exactly how I use leverage in cryptocurrency. We got a diverse audience, so feel free to navigate with the timestamps below. Because structure-wise, what we're going to cover is exactly what margin/leverage is, as well as when you may want to consider it, and from there, exactly how I use it. There are two terms essential to understand, and they're known as margin as well as leverage. This is a crypto-specific video, but if you're involved in the stock market, this is going to work in the same fashion. When it comes to margin, it's essentially a feature where you can trade with more money than you deposited. There are two types of accounts, a cash account and a margin account. In general, an account without margin enabled is essentially a cash account. If you deposit $100, then you have no more than 100 and no less than 100 to trade with. On the other hand, with a margin account, let's say you deposit $100 and buy $100 of Bitcoin. That Bitcoin can be used as collateral to borrow even more funds. Overall, with a margin account, although you deposited $100, you can have more than $100 to trade with. When it comes to margin, each platform, broker, exchange, they may differ in their rules of how they handle it. For simplicity, we'll use an example of $1,000 worth of Bitcoin to walk through any future examples. To have margin enabled or have that capability, maybe that $1,000 in Bitcoin isn't enough because your particular platform may need a minimum of, let's say, $2,000 worth of assets with them to have margin enabled. Let's assume that that $1,000 in BTC we have allows us to borrow against it in order to do any further steps. And so with that, we can move on to our next term, leverage. Leverage is essentially a multiple of how much you can trade based on how much collateral you have. It's usually expressed as a ratio. So for example, let's say your broker allows you to take leverage up to the multiple of 2:1. This essentially is saying that for $1,000 in BTC, you're allowed to borrow up to $2,000 in addition to this. Like this, your total account value would be $3,000 if you're fully levered. If you're able to take 5:1 leverage, then that $1,000 will allow you to trade $5,000, hence having a maximum total account value of potentially $6,000. When we're talking about margin, leverage, and when you may want to consider taking it, really comes down to the pros and cons. The obvious pro is you have more money to play with. So if things are going up and up, then essentially you're going to have more profit than just having that same $1,000 that you had to begin with. The other side naturally is that your losses are going to be supremely magnified potentially depending on what that multiple of leverage is that you're able to take from your platform, exchange, or broker. If you're levered 1-to-1, your $1,000 gets you another $1,000, and let's say you lose that extra $1,000 that you borrowed, then you would owe an extra $1,000. So your $1,000 that you had initially is essentially what you need to pay back. So in the end, this situation at 1-to-1 would result in an account of $0 and overall you losing $1,000 overall in this transaction. If you've heard about folks going into debt because of margin and leverage, it really happens after that 1-to-1 ratio. For example, there are some brokers out there, and this is literally their business on hoping that folks mess up or trades go south. And essentially, for example, they'll give you a 100-to-1 ratio. So your $1,000, you can borrow 100K against it. But if you do the math and kind of see and look at the numbers, 1% correction of that total position would have you at minus $1,000. So that initial 1,000 you put in, if you're down $1,000 on the position, the moment it goes even below that 1%, you're going to start owing money when you realize those losses. And really, there are rates that are given to you when you borrow against your own collateral. So depending on those interest rates, they can also be pretty high, and it just depends on the broker/platform, and you really want to know what you're doing before you get into it, etc. There's a lot of intricacy, nuances, and picking the perfect broker depending on your trading strategies, and it could be a whole video on its own. So the point of this video is just to explain that, hey, there's something that exists, and it's up to you if you want to consider it, but definitely do your due diligence. And the way I use margin is not going to be your multiples of 20-to-1, 50-to-1, 100-to-1. It's actually closer to 1-to-1, and I'll walk through it through an example to bring the point home. The percentages we're going to walk through as an example are also going to explain what a margin call is. At a high level, a margin call is essentially a notification to you from your broker saying, hey, the amount you borrowed versus the value of your actual collateral, it's at a certain ratio or percentage where we're potentially going to liquidate your assets unless you deposit more money to make that ratio and percentage between the loan and the value of your actual assets more in line/safe in their eyes. Looking at an actual numerical example, let's say I bought 10K of Bitcoin, and let's say that this margin call equivalent happens when that loan to value ratio is 83.33%. So today I have $10,000 of Bitcoin, and let's say on that 10K, I borrow 5K against it. So 5,000 is my loan, and my value of my assets is 10K, hence 5K divided by 10K is 50% at this current moment. Let's say that Bitcoin corrected, and that $10,000 worth of Bitcoin is now worth $6,000. And if we're being technical, let's say that $5,000 I borrowed against that $10,000 of Bitcoin initially. Let's just say it was stablecoin like USDC. Like this, the loan I took out is fixed at that $5,000. But because the value of my assets is now lesser, essentially $6,000, mathematically it's 83.33%. Depending on the platform, you may get a notification of a margin call, or that liquidation may happen automatically. What you can do to avoid a margin call is one of three things. One is naturally take less margin in the first place. Second is keep excess collateral in your account, which is kind of similar, but really saying that, hey, just keep that gap a bit larger, just in case your assets and fluctuation in value, if it happens, it won't affect you as much. And the third item is just be cognizant of what you have as your underlying collateral. For example, if you have USDT, USDC, or some type of other stable coins, you know exactly what your underlying collateral is worth. And on the other hand, if you have Bitcoin or Ethereum, they're not going to be maybe as volatile in terms of price action compared to some smaller altcoins. If these smaller altcoins go to the moon, and let's say you borrow a heavy amount in that short-term period, but let's say it corrects again, then that loan-to-value ratio may be really skewed really fast. So just be cognizant of what you're choosing to borrow against. And a quick line before we move on to our next segment. Essentially, we're playing with money that isn't 100% ours. So the usual, do your due diligence, have a plan. There's a certain cost to borrowing X amount of money. So do your math of risk versus reward. Is it worth it, et cetera, et cetera. You know how it is, but with that, we'll go on to the next segment. Moving on, we got our hands-on demo of exactly how I use leverage in crypto. And right before we get into it, the platform we're going to go over is called Nexo. And if you don't know what I'm talking about, feel free to check out this video here. But with that, we'll get back into it. So here I am logged into my Nexo account. And as we can see, portfolio balance of 10K plus. There's some credit line, which is essentially some credit I have taken out thus far. There's available credit as well. You have interest earned and a loyalty level of platinum. For all these type of details or extra deeper dive, feel free to check out that video and again, come back here. So that being said, over here, we got Bitcoin and Ether over here. So these are my two primary holdings. There's some others, but these are kind of the main kind of more bigger cryptos that I have in this account to borrow against, just in terms of my own personal reasons per liquidity and also just stability and otherwise. So with that, what we're going to do here today is actually do that hands-on demo of taking out some of this credit and seeing how that looks like. So I'll go to borrow cash or stablecoins. Once we navigate to this page, it says I can withdraw up to this particular amount. And if you see carefully, this Nexo premium rate of 6.9% per year, it's not totally free what we can take out. And this is given to me based on my loyalty status of platinum. So it does differ if you're a different type of level, and the interest rate can be different. So like this, I'm going to borrow in this situation USDC. And when I press USDC over here, I can choose to withdraw X amount. I'm planning to take this USDC to buy Ether today. And looking at Ethereum's price, we're looking at $3,828 and some change, and naturally it fluctuates in real time. So with that, I'll go back to Nexo. Back to our withdrawal funds from credit line page. If I press USDC, I'll be borrowing that today. So here, just to make our example simple, I'll borrow 390 USDC, and that'll buy me roughly 0.1 Ether. And so over here, just put a reason of how you get these funds, salary, trading profits, etc. as it says. So I'm just putting wages over here. So we're going to transfer 390 USDC. And in terms of Nexo fee, there is no fee in this situation. And what I like over here is to actually tell you what is the before and after situation if you withdraw X amount of credit from your credit line. And so over here, I say I agree. I say withdraw. And here I got to put in my two-factor authentication code. After putting in the two-factor authentication, the screen pops up immediately of withdrawal sent for processing, and I can continue back to my Nexo account. So coming back over here, as we can see, the available credit changed accordingly, and with that, the USDC also would be deposited shortly. Looking at the available credit, it's $705, which bumped up to what it was just a moment ago. And the reason for that is because the USDC actually hit my account. And based on what type of collateral you have in your Nexo account, you can borrow X amount against that. So for example, with Bitcoin and Ethereum, how much you can borrow as a percentage against the value of those assets is going to be different from something, for example, like USDC. Scrolling down, you have Bitcoin, Ether, and so our USDC of 390, we received it over here. Receiving our USDC, this is what I'm going to do next. I'm going to go ahead and press exchange where I can swap my USDC for Ether. So pressing this over here, I can go to swap, and specifically I'll choose USDC here, which I have 390 of, and here I want to receive Ether. And so over here, if I say 390, use all of the Ether, or rather USDC we have, then essentially I'm going to get 0.1 and change in Ether. So when I preview exchange, it basically says this is the situation. We'll get it instantly. There's no fee over here, and I'll say exchange. And that's it. I successfully bought this much Ether, and the balances will be updated in a few seconds. Covering the steps we took so far, it can be seen in the transaction history on Nexo. So essentially we took out 390 USDC first, and then there's a confirmation that it topped up that specific amount into the USDC wallet side. And from there, we exchanged 390 USDC for this much in Ether, and I specifically withdrew 0.1 ETH for the next step, and that cost 382 and 39 cents USD, not USDC if we see the careful amounts over here. But essentially I'll have some left over sitting there that's borrowed as USDC, and I can use that USDC to repay that delta amount, so it would actually be a zero difference from 390 USDC minus what I actually wanted to use to purchase Ether. So here we are at the platform named LedgerX, where you can trade options on both Bitcoin as well as Ethereum. So taking that at a high level glance, there's an overview video for this whole platform, so feel free to check it out right after this, and you'll see a card / the end screen soon enough. So with that, there's Bitcoin, Ethereum, and available for trading over here we have 0.1 ETH, which is exactly the amount of what's considered a contract size for this platform. So at 0.1 ETH, this is the options chain. So you have expirations date over here of October, November, and December. And as you can see, I have a few open positions over here at certain strikes. And although we won't go over what the average cost I paid for my Ethereum before I sold these contracts at, we'll be looking at a fresh example, and that's exactly what we're going to be doing here today. As we saw, I purchased Ethereum at $3,900 roughly per one Ethereum. Hence that 0.1 ETH was $390. Now, that being said, if I agree to sell it at $3,000 over here on 2021 December 31st, essentially it'd be less than what I actually paid for it. So I won't consider this option in general. You can do this, but for our purposes, I'll skip over this and go to the next strike price of $4,000. Now, we bought at $390. It's $4,000 if I agree to sell it. So essentially making a little profit, $10 essentially, or $100 if it were a whole Ethereum. And from a percentage return standpoint, total on this trade, we'd be looking at this bid and ask over here. So you got a bid of 1,200 and an ask of 1,340. And for simplicity, looking at the bid of 1,200, seeing how much 1,200 is divided by the average cost that we paid, aka $3,900 in Ethereum, it's roughly 30%. And when you look at that extra $100 you would get if Ethereum closes at 4,000 or above on December 31st, 2021, your total profit is going to look like this. There are roughly 2 months till expiration from the time of this recording, and so from a percentage standpoint, we're looking at 31% roughly if you consider purely $1,200 premium based on our average cost of $3,900. And when we flip this and actually make this $4,000 is what our total execution cost / price would be, we're looking at a premium of $1,200 plus the fact that we're selling in potential profit of $100 on that 3,900 to 4,000. So we're looking at $1,300 in premium plus total profit potential divided by our cost of 3,900, which is going to be 33.333%, etc. as the total profit on this trade. Ethereum by December 31st, it could pass its all-time high and go race to 5K, 6K, and more. And it's all speculation. I don't know the answer, but why I'm sharing this is essentially to show you kind of the logic and thought of how I use margins / leverage in this situation. So coming back to the options chain, where I'm agreeing and thinking from a strategic standpoint is essentially 7K is where I'm okay to sell it, because when you look at the premium that we're looking at potentially, 609 if you had a whole Ethereum, so with 0.1 ETH, we're looking at $60.90. So this total trade in terms of profit potential, first looking at the premium, we'd be looking at basically 609, which would be roughly that $60.90. But for our purposes, to make the math simple and easy to follow, we'll consider it as a whole Ethereum because percentages will be the same. So in premium for around 2 months, we're looking at 15.6%. Now, this is purely the premium upfront. So if there was that interest rate per Nexo in terms of their cost, when you do the math, this is way more than even their whole year of APR if we were to hold this position for a full year. But in this case, it's only 2 months, so it won't be that total 6.9% in terms of interest. It'll be far less. So looking at it over here, 15.6%. and this is just a premium. But in terms of total profit potential, we'd actually be looking at an execution price of $7,000 minus what we paid of $3,900, which means $3,100 profit, but because 0.1 ETH, it's essentially times 0.1. So $310 profit to be made on $390 invested. But because we get that potential premium, we're also looking at $60.90. So our total profit potential would be $370.9 on $390. And it doesn't take a genius, but if you look at it, it's basically double of what we actually invested. So almost 100% return. And if we want to get really specific, 370.9 divided by 390, we're looking at 95.1% in terms of profit potential. You can play around with the same logic with other strike prices, so feel free to check it out. There are no referral links for LedgerX at this time, but there are other links in the description below, so feel free to check it out. And now we'll do an actual hands-on demo of exactly me doing this in real time. So looking at it over here, we got a $7,000 strike. And just for our purposes, I can go for the mid price, which is usually kind of a normal thing to do when you're trying to get the most premium, but also getting that execution capability. But in this situation, I'm just going to go ahead and press this. And what happens is it populates over here, and I'm going to say one contract, which it understands that the underlying over here is 0.1 ETH, and the premium I'm looking to collect is $60.90 as we discussed, and there's actually a fee of 15 cents over here for this contract in general. So looking at it this way, I can go sell short, and when I press it, it basically says what it says over here, where your break-even price is 7,609, and the reason is because 7,000 is a strike, we collected $60.90. So the moment Ethereum passes 7609, in theory, I'm losing money, but really I'm just leaving money on the table. But this way, if I was to wait till December to see if Ethereum went to 7K, what if it doesn't? Then it doesn't. But also here, I'm saying that, hey, if it goes to 7K, at least I'm getting that much more in general, even if my Ethereum was called away. That being said, right over here, we go to confirm sell short, and order was received. And if we see our open orders, there's actually none because it just got filled. And just like that, there's a -1 over here, which means I sold one contract short for 7K. And that's pretty much it. This is exactly the process from start to finish in terms of your hand-on demo, and exactly how I use margin/leverage with crypto. So with that, thanks for coming to the end. And you know how it is. Subscribe, like, you know, all that good stuff. But with that, peace.